IFA India. My name is Sudarshan, and I'm one of the members of the IFA Chennai chapter. I'll be moderating today's session. Maybe I should say I'll be a facilitator for today's session. So before I set the context for today's session, I really hope you all are keeping well and staying safe. It is indeed an unfortunate black swan period that we are going through, and hopefully the end is near. Despite the era of pandemic surrounding us, one of the positive things that emerged during this pandemic has been the knowledge webinars. As they say, every cloud has a silver lining. Uh, Certainly, these knowledge sessions are one of the silver linings. Uh, in specifically, I see quite a few non-IFA members as well here over the webinar. IFA India, thanks largely to its selfless volunteers and leaders, have endeavored to bring some top-class international tax content. I'm sure many of us are still reeling from the hangover of the IFA masterclass sessions that were held last month. Continuing with that, our objective at IFA has been to make use of the current situation in a positive manner and thereby primarily bring a global perspective at your doorstep, which actually in a normal world would be extremely difficult, maybe for some annual conferences or so. So therefore, continuing from where we left at the masterclass and to keep the rhythm going, today we have our session on key tax considerations, inbound and outbound structuring from a Singapore perspective. Uh, Today's expert who will be dealing this session is Mr. Sanjay Iyer. Sanjay is the director of IQEQ, one of the leading investor services firm based out of Singapore and Hong Kong. He is a chartered accountant and master's in tax law by qualification. And Sanjay is quite familiar to a lot of us at IFA because he was the global chair of the IFA YIN, the Young IFA Network, where we promote young talents in the international tax arena. And Sanjay was the global chair, so he's quite familiar. One fun fact about Sanjay is he just revealed this secret. So I'm spilling the beans. Sorry for it, Sanjay. Sanjay is on the verge of launching a video channel where he'll be combining food analogies with taxation. So you may definitely look forward for some spicy and tasty endeavors from Sanjay, because when it comes to tax, it can only be spicy. I can't think anything beyond spicy. Uh, Probably today's session may also act as a prelude to it. We can say pre-season one for Sanjay. We're doing it virtually. Now today's session, getting into the context, is we wanted to make it very interactive because the idea is we want to understand from India perspective. We're all quite familiar, or we have adequate knowledge or wherewithal to understand what happens from India perspective. So therefore, we also wanted to get Singapore perspective, which even though we rely on external consultants, councils, but still, if we understand what happens really at the Singapore ground level reality, so that will really help us to factor while advising or while strategizing from a tax perspective. So what we have done is, instead of trying to keep it as a generic overview of tax and regulatory Singapore perspective, which I think we can have plenty of such resource on the web. The idea is we wanted to make it more objective oriented than abstract. So what we have done is we had floated few questions prior to Mr. Sanjay so that he can take it up during session, and we also encouraged quite a few members to also post questions when we sent out the our mailers about the program. For those who are part of this, if you have any specific question concerning Singapore aspect, please feel free to drop in at the Q&A box. I'll be facilitating, so I'll be asking it as and when. So we're not going to have, even though we may have a separate Q&A session then, but again, the objective is try to more have a kind of a tete-a-tete or a more Q&A kind of a session. So even though Sanjay will also cover the broad aspects pertaining to it, so I really would request all the members, participants present in the webinar to kindly throw in your questions, any questions, and I'll bounce it off to Sanjay, who will take it up during these sessions. So we have identified few questions as a start off for Sanjay to take it, and then carry the thread forward. Uh, Sanjay, so before I hand it over to you, let me first shoot a very basic fundamental question. Even though we know the answers to it, but would also be happy to listen to your perspective. When it comes to outbound structuring from an India perspective, or even from inbound, first one country which obviously comes into mind is Singapore. Y- why Singapore? What is so special? We all know very good regime, but I would be happy to hear your perspective. Why is Singapore a more attractive destination?
I mean, to me, I think Singapore's main benefit, I think in the Asian context, but even the global one, is the fact that it marries effectively the certainty and the security that we've had in the West of laws, of rules, of regulations. It's safe. So we're now moving into a substance world, right, of business, whereby you need to ensure that any structure of anything you have has people willing to go there, people willing to live there. Singapore has that going for it, that it's a safe place. People speak English, and for most people around the world, I think you'd find your community there and can live there well. Marry that with an attractive tax system, legal certainty, etc. I honestly can't think of a country in the world that marries those two things together. There are many places that have low tax regimes, but you probably would never move and live there. And they're very desirable places that may have regulations or rules that I think ultimately mean that you won't go there, right? And especially in the Indian context, it is so close, right? You can, well, in the days when we could obviously fly, you could conveniently go and have a regional headquarters of your business sitting in Singapore. Senior management in India can easily travel and vice versa. So I think in a way Singapore is lucky in a sense that it has had this head start from the days when the country was founded by Lee Kuan Yew. I think this has always been the thought of Singapore as being an investor-friendly place, whether that's people having hubs to go into countries, such as in the Indian context, let's say, or an Indian company saying, I want to go outbound, where can I have a hub outside to manage my Asia or let's say global operations outside India? I think it's well placed in that regard. So I think in these days the rules and the regulations are very similar, but I think you should look at the soft side of things and let's take in this sad COVID environment, I think Singapore is a very regulated and safe place in that regard, right? If we're worried in the future of, okay, which country is going to be safe, which country is going to care about making sure these rules and enforce them as well, right? You may have heard the phrase Singapore is a fine city. You may have heard this phrase in the olden days, right? So I think even this post-COVID, I honestly believe that we will see a large migration of businesses and people to Singapore post this because they will probably feel safer and they'll feel, oh, my family is safe there. So that's initial more touchy-feely type thing. Obviously, through the rest of this presentation, we'll talk more technical aspects, but I think definitely in the substance age, your clients, your companies are going to be faced with the question of, okay, if we want to go outside, where's a place that we can move our senior management or get the right people? And honestly, I think Singapore, that's probably the thing that Singapore has most going for it. But anyway, let me start with the presentation. So today, I think I'm going to be focusing on 4 main angles. I'm going to try and do this both from an outbound situation from India into Singapore, let's say for the regional headquarter part, also for the case of, let's say, a foreign company coming into India and thinking about having Singapore as its headquarters for various reasons, okay? So obviously I'll discuss why Singapore, the actual process of registering in Singapore and what you think about, and then corporate tax and personal tax issues in this regard, okay? So why Singapore? I think we've obviously talked about the non-tax factors now, but in terms of tax incentives, for very big companies, Singapore has governmental bodies that actually are based in India that have the pure role of marketing. So it's a weird thing in the sense that Singapore has marketing hubs in every major city in the world saying, hey, big companies, please come here. We'll give you tax incentives. these tax incentives are considered, BEPS safe in a sense that they're all backed up by substance, by rules, by their annual checks. Inherently, you're talking about number of people, you're talking about business spending, those types of things. So for very big companies, they are often in Singapore primarily because they are approached these government authorities in advance and effectively look to meet the certain criteria that exist in order to have, let's say, beneficial taxes slightly lower than the normal corporate tax rates. In terms of the tax system itself, Singapore is a partial territorial tax system and has a very low corporate tax rate of 17%. So often, if you think about the Asia Pacific region as well, Singapore is one of the lowest tax rates. So that clearly is a benefit. Geographical location, I think, is one as well. If you're considering to have an Asia Pacific business, I would view Singapore as almost the center of that geographically, that you can pretty much, in 5, 6, 7 hours, pretty much get to the entire part of where you're going. I think these things make it very suitable because you may or may not know, but Singapore's population is relatively small, 6, 7 million. And so therefore, for hubs themselves, there's usually not loads of business within Singapore. So for the majority, most senior people are pretty much traveling all the time and doing business development and growing and managing the operations outside of Singapore and Asia. In terms of registering in Singapore, to be honest, it's relatively simple, but before you do so, you have to think of the various ways you can do so. So obviously there's a standard Singapore company that you can set up, which most people do. However, some clients, and I'd say even including Indian ones recently, have been setting up branches of their Indian companies in Singapore. I think this is primarily why this is done is because of claiming back double taxation relief. Because if you think about it, if let's say your residence country taxes the received dividends, right? So you may have the Singapore company taxed at 17%, but then you may not get a credit when the income is paid up in some circumstances through a dividend. Let's say, for example, the country doesn't provide an underlying double taxation credit. So often, and I'd say US companies with most common of these, they operate in Singapore through branches. From a compliance perspective, it's pretty equal in terms of this, but obviously a branch can't take advantage of double taxation treaty benefits while companies can. Some people also operate as LLPs or LPs. So in the case of a fund, you may have seen limited partnerships being used. So but I'd say the most common vehicle is a Singapore company. One of the most, I guess it's relatively recent, probably a year or two now, has been going is inward redomiciliation. So this means that if one of your clients has an offshore company, let's say BVI company in their structure, and these, as you know, offshore is not something that authorities or generally banks like to manage with, you can actually inward redomicile, which means that the BVI company effectively becomes a Singapore company in the law. And the positive is often this doesn't create any tax consequences because usually countries treat a redomiciliation as a tax neutral event. So these are considerations you need to have, but as I say, most people will choose a Singapore company as a default. So in terms of the inward redomiciliation, as I just mentioned, you would be looking at an offshore company, a BVI company to Singapore. You'd need to meet a threshold for significant size. So this is 2 of 10 million turnover, 10 million assets, and 50 employees. And you'll need to obviously be a solvent company. It takes greater than 2 months. Very few companies have actually done this because these thresholds are usually quite high for offshore companies and companies you want to do. But I think it's something to just consider. And these thresholds may go down over time. So I think it's definitely something you should consider. In terms of branch subsidiary, we obviously discussed that the main reason I've seen this for would be for foreign tax purposes. Branch also has one negative, that the financial statements of the, let's say, the head office, the main company, will be published publicly available in Singapore. Now, that for most clients is not an issue, but it's something you need to consider. A subsidiary has obviously tax treaty benefits and has the audit exemption too, but I think these are pretty small things to consider. So I think in the context of whether you're going outbound from India or inbound into India, I to be honest, would think you would see a subsidiary in most cases, excepting in some specific cases of a branch, but I really don't think you would expect that to be the case. In terms of branch local requirements, I think the key one you'll need to consider is a local agent. You need to get a local individual. So firms like mine provide this local individual to act as a local agent. The agent pretty much acts as the main point of contact for the authorities in case of any issues. Then you'll need to do the standard audit, accounting, and tax. Company requirements, one of the main, I guess, differences there is you need to have a local director versus a local agent. Now, I've had a client before who's told me that he wouldn't want any third party on their board. So often those clients will choose branches, but most people have local directors. Firms like mine provide those. There is an audit exemption in place for companies, but the thresholds obviously are quite high. So in most cases, clients won't be able to take advantage of this audit exemption. Then you have a tax return, but obviously you're allowed 100% foreign ownership. Timeline to set up, I mean, basically it's within 24 hours of having all the required documents. The opening of companies now is a regulated activity in Singapore for company secretaries. So you'll need to get relevant KYC, compliance, etc. But the positive is once we get all of that, it's an electronic submission and can be done relatively shortly. Now, in terms of next steps, obviously, once you've set up this company, as I just mentioned, you need to consider substance and how you're going to operate your business. So the two key things are, okay, immigration. In most cases, clients will want to have a senior person from their home country come to Singapore. Now, in the case of, let's say, an Indian company, right, looking to, let's say, internationalize their business, in all the cases I have seen, likely either a family member of the promoter or a senior member of the promoter's relevant company will move to Singapore. So immigration is a very important part. I mean, in this current COVID context, obviously it's a bit harder because countries have to a certain extent limited their borders to new entrants for obvious reasons. A bank account as well is another consideration. It's getting much harder to do so. So I'd say these are the two main issues that you'll face. I think setting up a company is relatively easy. In terms of immigration, there are two ways to do it. So the vast majority of people go through the employment pass route. There is also this global investor program that allows, I'd say, the creme de la creme, the most senior, wealthy, successful people to get permanent residency in Singapore directly. But the thing I want to mention is that permanent residency in Singapore is not technically permanent. It is a renewable 5-year scheme. So people shouldn't think that even once they've gone through the scheme, they will get renewed, although the common practice is for people to be renewed. But as I said, the employment path would be the normal route the vast majority of people will go on. And this PR thing is more for Singapore in itself to, in a way, invite or accept specific people for specific reasons to the country based on meeting defined criteria. In terms of the employment pass, usually it's for 2 years. You'll need to set up the company that we've just discussed to get it. There's a minimum salary threshold, but often in practice, the threshold is much higher to increase the chances of getting it. The assessment the authorities make is basically mainly made on a few things. One, on the company itself, its business plan, what work experience that the individual has, what education they have, and what salary. So education, you wouldn't think so, is actually a very important thing. So I've had clients in the past who've run successful businesses, have very good CVs, have very good work experience, and because they've not been able to prove education, they've had problems in applying for their employment passes. So this is a process which I think you should handle with care, and it's something that we do, but it's something that, and especially in this current environment, I do expect it to be harder to get these visas and for them to take a longer time to be processed. You may even have initial denials because the process is initially handled via let's say an automatic computer process. You may have to go through 2-3 appeals. So expect the process to take about 2-3 months at the least, and you could even get rejected even if you or your client are, let's say, important people who in your view would think to be employed. So in terms of the global investor program, there are 3 main options. basically you would invest money into a new business, in a specified industry, invest in a specific fund, or set up a family office. Now, notwithstanding all of these options, you will still need to put in 2.5 million Singapore dollars, which for the type of people they're looking for here is not considered a lot, because they're expecting extremely wealthy people and businesses to join and have a significant business track record over a period of time. So this is something which is really specialized and shouldn't be something that's considered that everyone can hire. And I would explain that for most people, once they have their employment passes, after a specific period of time of living there, they can apply for permanent residency, but there is no timeline, there is no criteria. It is up, on the whole, it's up to the discretion of the authorities to approve them, and they go through that process. Now, in terms of bank account, this is something which, for a business, now in our case here, from an Indian perspective, I would expect all the entities and structures that have been set up will have a staff, office, and activities. So this honestly shouldn't be a problem. Even banks now in this COVID situation usually they would expect the director or the individual to visit Singapore. I think they're now allowing virtual meetings to do these things, but obviously things are taking longer. Usually, if you don't have any activity in Singapore, opening a bank account now is much, much harder and almost impossible. So you're having to go through perhaps banks that are based outside Singapore. But the whole process will take about 3 months. So unlike the olden days when I understood in the 90s, for example, where bank accounts we open up within a day and everything is done quickly, now because of various compliance and KYC requirements, this is something that is much harder to expect to happen quickly. So corporate tax-wise, in terms of looking at this, I think whether you're talking about outbound Indian companies setting up a Singapore subsidiary outside or a Singapore company being set up to go in, I think these questions really equally apply. Basis of taxation, whether you're talking about investing into India and having income being earned from India, or having a Singapore entity that itself invests, let's say, into other subsidiaries below, and you're having to deal with the income from that, fundamentally it's the same. Obviously, there are specific issues in each situation. But what we're going to go through here is basis of taxation, capital gains. Obviously, there is no capital gains, but it's a bit more complicated than that. Withholding tax, this is a key issue that trips up a lot of clients because they don't expect this withholding tax burden to exist or don't do it at the appropriate time and face issues. And the last one, which I say is probably a topic I talk most about with clients all around the world now, is tax residence. And the fear, because many countries, including India, now have quite detailed residency rules in, let's say, the parent company jurisdiction of the Singapore company. And there's usually a question of where the place of effective management of the Singapore company really is. So this is something that we always talk about. Base of taxation, as I'd mentioned, Singapore is a partial territorial tax system. This means that it taxes Singapore-sourced income and also foreign-sourced income received in Singapore. It has a 17% corporate tax rate. There are exemptions up to the first 300,000 of Singapore dollars of income. So the effective tax rate of income is usually lower than this, but this is basically the number. And to be honest, in the region, I think Hong Kong is probably the only place that has a similar tax regime and a similar tax rate. I think other countries are reducing their rates, but I do have a concern in this current COVID environment whether tax rates will stay the same or will they go up over time. So usually in the context of a territorial tax system, the question always is, where is the source? Because if your country only taxes income that is sourced in a specific country, so for passive income, it's very easy. So it's obviously where the location of the payer is. The main concern from a Singapore context is usually, how do I take care of this withholding tax? So usually, obviously, you use treaty benefits to reduce withholding taxes. The interesting thing of Singapore, and I think this will be discussed later, is that in many of Singapore's treaties, there's a requirement to remit the income into Singapore in order to get treaty benefits. And I've actually dealt with an interesting case recently that my understanding was the Indian authorities would basically there's a clause in various Singapore treaties called the limitation of relief clause, that says that treaty benefits will only be applied to the extent the money is received in Singapore. Okay, but our interpretation is this only applies to income that is only taxable if it is received in Singapore. So it creates interpretations, and I had a recent case with an Indian advisor who's asking me my view on this clause, and actually for another client, I'm now writing into the Inland Revenue to get clarification from their perspective to clarify that this article only applies in this specific situation. We also have a concept of foreign tax credit pooling. What that means is you can pool various foreign taxes in order to greatly benefit, because often Singapore only applies a ordinary foreign tax credit, which means it's the higher of the low of the Singapore tax paid and the attributable amount. So in some cases, you therefore may have some wasted withholding tax because the Singapore tax is not as high, if you understand what I'm saying. Singapore also provides unilateral foreign tax credit. So the reason I want to point this out is, on the whole, Singapore principle in international tax and tax matters is they want a reasonable result. You'll never see Singapore seeking to double tax you or to be creating an issue. They will follow their rules, but on the whole, they seek to be reasonable. So in this case, even if there is no treaty, if a taxpayer is double taxed, on the whole, I've seen them provide double taxation relief, even if they don't technically have to in situations. So that's fair in that sense. Active social income. So there was very much a historic structure of companies setting up Singapore companies with activities outside of Singapore, no bank account in Singapore, and basically claiming no Singapore tax. The authorities in recent years have queried companies on this, and really their interpretation, based on my understanding, is that they view that active income is only sourced outside Singapore if it's through a fixed place of business. This is obviously not consistent with the with my, well, I guess on court cases that have not happened in Singapore but in other places that have viewed, for example, some Hong Kong cases have mentioned that source is where the work has been done. So I've had interesting cases with the revenue where we've discussed the distinction between what these court cases have said and what the rules say, but ultimately I've been successful that to the extent that you can demonstrate that the activities have been carried out outside Singapore, you've been successful in applying for these claims, but obviously authorities tend to not like to approve these things unless you have evidence. So luckily my clients had appropriate evidence showing that these activities are being carried out abroad, etc. There's a question always in these queries of has any taxation been paid outside of Singapore, although this is on the law. As I said, luckily in most of my cases, the activities have been carried out in jurisdictions which have levied no tax. So ultimately the authorities are then okay. So Dubai is a good example of the situation. Remittance, this is a question that I often get answered. What does remittance mean? There are three factors. One, paid into a Singapore bank account, which is an obvious criteria. Satisfaction of any trade debt in Singapore. So let's say you use the foreign income, you don't bring it into Singapore, but use it to pay a debt of the Singapore company. There used to be this whole discussion on what is a trade debt. Luckily, the Inland Revenue, in a meeting with the SIATP, which is let's say an independent body that deals with taxes and from a taxpayer point of view in Singapore, they had a discussion and they agreed that unofficially that non-trade debt would not be included in this. So let's say an investment holding company paying its expenses or paying a back-to-back loan. Now, I previously been asked by clients about this to say, okay, well, can I rely on this SIATP guide? Now, in my view, obviously you can never rely on things 100%, but I think I'd be fairly comfortable in saying that this exists because I don't believe that the SIATP would have published such guidance if they hadn't discussed it with the Inland Revenue. Obviously, it's up to the Inland Revenue to make a final decision, but I think this is a positive step. And then the other part of remittance is movable property into Singapore. So the scenario is I buy a car, for example, overseas, and I bring that car in. Now, the whole historical background to the remittance clause, based on mine, I was around the time, was in the 70s, I believe. there was a whole concern of round tripping. So the concept is a Singapore company would earn foreign income, but actually it was Singapore sourced income. There was a concern of would this issue arise? So they took a view of dealing with this by having a remittance clause to say, okay, even if it's foreign, if you bring it into Singapore, you'll be taxed. So that's why you have things like moving movable property into Singapore, because that's probably what they considered at the time. Now, foreign source income exemption, okay? So in most cases, as I mentioned, Singapore doesn't want to double tax people. It wants to create a situation whereby a taxpayer's life is made easier, right? So the foreign source income exemption basically came in to say, okay, if you have dividends, branch profits, or services that have been subject to tax overseas, the company's Singapore resident, and the headline tax rate, remember, not subject to tax, the headline tax rate is over 15%, they're going to exempt you. So this is very useful in terms of if a company is earning foreign source dividends, we don't get double tax. So ultimately, in most cases, withholding will probably be higher than this in this sense, because most countries have a higher withholding tax than Singapore's tax rate, but I think it's a very good step in making taxpayers' lives easier. Even better, they have a part in the act, and a lot of people don't know about this, in Section 12 of the Income Tax Act, 1312, they cater for situations where the foreign source income exemption doesn't apply, okay? So if we go back to the criteria here, let's say, for example, the country does not have a headline tax rate of 15%. Let's say it hasn't been subject to tax overseas for a specific reason. Let's assume they have not. So one good example is if I have a Singapore company, it has a US subsidiary. In between the two of those is a UK company, okay? The US company is paying taxes. It pays dividend up to the UK, but because of the UK-US treaty, there is no withholding tax, so 0%. There is UK doesn't tax foreign source dividends, and UK doesn't have a dividend withholding tax. Okay, so from the foreign source income exemptions perspective, no tax has been paid in the UK, because remember, I've received the dividend from a UK company, right? So technically, the FSI doesn't apply. So Section 1312 has a list of, I think, six scenarios, A, B, C, D, E, F scenarios, which cater for things like this. You can also specifically apply to the MOF, and I've done this in scenarios before, Ministry of Finance, to say, hey, I have some foreign income. It doesn't fully match what's in the foreign source income exemption. It doesn't fully match what's in Section 1312. Can you please help me in advance? And I've seen them use their common sense to help taxpayers as long as they feel that there has been taxation and there's a reasonable basis, and also Singapore benefits, because ultimately the benefit to the authorities to extent is that you've brought the money in to use it within the economy. So when I've gone through these questions with the authorities before, they mainly question on, hey, what's the money going to be used for, which makes sense.
Sanjay,
yes.
Sorry for interrupting you. Just as we discussed, to keep this more interactive, I've got a couple of questions coming in. I have my own question as well. And also thank you for taking up the immigration part, because this is one of the questions which we also raised to you. Is there any accelerator, any fast track program for resident entrepreneurs? The question that is here is which you've touched upon briefly, but then maybe this will also act as a summary of whatever you've discussed so far. The question that is coming up is, that has come up is, can an immovable property which is bought in Singapore from foreign sourced income, is that allowed? Is there any restriction to buy an immovable property from a non-Singapore sourced income?
No. So let's think of the scenario. So you are saying that. So the scenario is that. So okay. First of all, individuals are not taxed on foreign sourced income. So let's assume it's a company, right? So it's a Singapore company that has foreign sourced income, and it wants to basically use the money to buy an immovable property in Singapore. So let's say a commercial property, using that example, right? Now, in practice, this would, and the scenario has to be therefore that the seller is not based in Singapore, because otherwise you'd bring the money in, right? theoretically, based on the reading of these three clauses, right, you haven't brought any movable property into Singapore, you haven't satisfied the trade debt, and if you haven't paid the bank account, paid into a single bank account, then technically based on this, I'd have to think about it further, but technically based on this, it wouldn't apply to any of these clauses, right, technically?
Exactly. So this is precisely the question that the participant wanted to know, because you mentioned movable property. So what happens if it's immobile property? Is it excluded?
No, but to clarify, but in this case, it's movable property brought into Singapore, right? So using your same example, let's assume the car was already in Singapore, but you just paid an overseas person to own the car, right? The same thing would apply, because remember, this has not been brought in, it was brought in many years ago, 50 years ago, and was brought in for a very specific purpose at the time. It was not considering all these funny things they could do, because in those days, for example, you would never have a foreigner owning a probably immovable property in Singapore in the 70s, right? Probably, right? Probably, but in those days, no one ever thought of foreign real estate, right? In those days, usually, it wasn't as thing as it is now. But you're completely right. Yes, sorry. Please go ahead.
Right. So that's it. The next question is again on the source, which you had explained. Of course, source is such a nebulous into the entire international tax controversy, largely on what is the source.
Sure.
The question is, you can also take this as kind of an example to what we have discussed. Income arising for a Singapore company, where income arises outside Singapore, what shall be the tax implications if the income is received in Singapore, or income is received in a bank account outside Singapore?
Okay, so do I take it as a fact that this income is considered to be foreign source? Is that my assumption?
Yes.
Okay. So if it's foreign source and I keep it in a bank account outside Singapore, it's not taxable. But the next question is, what do I do with the money? Okay. Now, what I always advise clients to do is reinvest it outside. I say never use it for expenses of the company. So say paying me, never use it for any sort of expenses or anything. Just use it for reinvestment. So often clients, if they have a holding company in Singapore, an operating company, they will likely have overseas subsidiaries, or maybe they don't own them, but they have other ones, right? So I say, okay, then loan the money out to another place, or buy an investment, or keep it outside, basically, is the idea. Because the first step is easy, pay it outside the bank account in Singapore. But the issue is then, well, you want to keep capital employed, right? Ultimately, correct? So that's the way I always say is reinvest it outside. Now, if the money is brought into Singapore, then it's subject to tax at 17%. But you will be able to obviously deduct expenses against that and then take a foreign tax credit if the income has been taxed overseas. So usually there's no double taxation involved.
All right. Okay. Thank you, Sanjay, for that. One final question before you move to the next segment is, you mentioned about SATP and IRAS guide. Probably on my own personal behalf, the IRS e-tax guides have been a fabulous read, very precise, very clear, something which we look forward even from a knowledge perspective. So my question is, how does it work legally? How binding they are? How have the courts have given a diverse view or have taken a divergent view? And how, even from a tax administration perspective, I know Singapore tax authorities are very friendly, but then have there been any instances where they've diverged? How does it work at the ground level?
Okay, so let's take a few things. Firstly, the sad part is, and that's why I wish I was an Indian tax authority. We have an average 0 court cases a year in tax. Okay, so we have virtually no jurisprudence in that sense. There are 1 or 2. If we get one, it's like big news. Okay, because the culture of the country is to not have disputes in public. It is to talk with the taxman behind closed doors, settle with him, and conclude. There's not a culture of fighting. There's not a culture, because to be honest, both sides are reasonable or try to be reasonable. So in India, my understanding is in some cases you may get unreasonable situations, right? So taxpayers are forced to go to court, is my understanding. Maybe I'm wrong. I look forward to hearing from you on that. So if we take that in context, therefore the e-tax guides themselves are written by the Inland Revenue. and you're usually only talking to the inland revenue. So usually if you follow what the e-tax guide says, there tends to be agreement. Now, obviously, if you have a situation whereby the e-tax guide is imposing something in addition to law, then I would take the position, this rarely happens, but I would take the position that, I'm sorry, inland revenue, you can't create law, right? So I would fall back to what the Income Tax Act says and say, the Act doesn't say that, right? But in that situation, I've still seen them being reasonable. Is they'll say, good point, you know? They'll say, oh yes, this is my scenario, that's right. In fact, I have been involved in situations whereby I have had queries with them and they have updated the e-tax guide, maybe not because of me, but the timing was very coincidental. They have updated the e-tax guide based on discussions with taxpayers. Okay? So it's very much a collaborative process, which is probably weird, very weird in the Indian context, right? But it very much is that as long as you're honest, straightforward, and tell the truth, right, you'll get the result that you're expecting in Singapore on the whole, right? And as I mentioned, the fact that you can go to the Ministry of, and I've even gone to the Ministry of Finance for a stamp duty matter and got them to ignore sections of the specific stamp duty matter we were dealing with, because in their discretion they felt that this transaction should be undertaken, but there was a long process. It took 1 year to get it done because they were going through these reasons and understanding. So it shows that they're open. But so you didn't think so? Technically, they have no standing in a way, a weird way, because it's just the Inland Revenue's interpretation of the law. But often they have reasonable positions, so taxpayers utilize them, is the way I say it, you know? Okay?
Perfect. Let's move on. Thank you.
Thank you. And then, as I said, this SITP thing, pretty much it looked at a scenario, for example. Oh, I've got a question. I just saw a question up there about a hybrid instrument. Is that correct? Did you see it, Sudarshan? I just saw.
Yes, Sanjay. I just spotted it. I think it's a dividend income. I think this is one of the questions we have factored in the consideration. So maybe we can take it up when you touch that particular part.
But I'm not sure if I have a separate slide on it. So maybe I'll address it now quickly. So what was the specific question? Because I didn't really see it. Well, why don't I continue? When you get it, then we can continue. Okay, no problem.
Sure.
Cool. So as I was saying, this SITP thing seek to clarify, for example, that if you have a holding company, as I've mentioned, and it itself does not carry on business, because in the Singapore context, a holding company doesn't carry on business. It cannot therefore carry out a trade, and if it doesn't carry out a trade, therefore debts incurred by holding companies wouldn't be covered under this issue of paying trade debts. But that was just a smaller set. So that was a very important clarification, because before then, we were all advising and saying we don't know, because we don't know what a debt incurred in respect of a trade or business in Singapore meant. So I always said, no, that excludes holding companies, but we never had confirmation. Corporate tax rate, as I've mentioned, it's 17%. There are startup and partial exemptions that move this effective tax rate down, but ultimately 17 is a good rule of thumb. It's probably 15 in most cases, but that's a good rule of thumb. Capital gains, okay? So this is one of the fun questions I get so often when I advise this from India and around the world. They always say, Sanjay, Singapore has no capital gains, so cool, I can set up a holding company and there's going to be no tax, right? And I always say you are completely right. There is no capital gain, but, and they never like hearing this but the but is to come. Trading gains are taxable. So I'm not sure in the Indian context if you understand the concept of the UK badges of trade. So it's this old historic concept which talks about there are 6 badges of trade, I think. What is it? A period of holding, frequency of transaction, why did you buy, why did you sell, your means of financing, and I think the last one was the nature of, a lot more questions coming. The nature of the asset itself. So is the asset something that you would want to know? So let me give you a good example. So recently we had a client who wanted to, they set up a Singapore company, okay? It's an Indian structure. So they're an Indian company with a Singapore subsidiary, and they basically set it up and they developed IP, okay, over a 3 to 3 year period of time, okay? And then they wanted to, what they wanted to do was, the Singapore company was then going to sell this intellectual property that was being developed to a new US holding company, okay, as part of the restructuring, okay? So if you look at the badges of trade, so they asked me the question, would this gain after 2 3 years be taxable? So we take them through these badges, right? No frequency, only one transaction. But the question comes, why did they set up the structure in the first place, right? What were you planning to do? Was there initial intent to effectively create this IP and sell it quickly? What was the whole situation, right? And then why are they selling now? Well, for an internal restructuring for various reasons. Was there any financing? No. Would IP be something you buy and sell, right? So these questions always come out. I think on that one I said, well, I don't think so, because you didn't principally buy the IP, you developed the IP. But it creates an interesting question that it's not a clear answer. The only clear answer we have is that the revenue a few years ago came out with a specific exemption that if you held something for 2 years, ordinary shares specifically for 2 years, and held more than 20% of that relevant company, they would exempt the gain. But obviously there are many scenarios. Let's say you don't have ordinary shares, you hold it for 1 year and 9 months, you hold 15% instead of 20%, and these questions come up. So, but ultimately, once again, the revenue are reasonable. They're not going to come up with a ridiculous position, but you have to know in your mind, hey, there could be tax. Now, often in these capital gains, there is underlying taxation on the sale in the foreign country anyway, so this often is not an issue. Withholding tax. So this is something which, to be honest, is a practical issue more than anything else. I don't think services will really impact you guys unless it's an Indian company providing, let's say sending some people over to Singapore to do a project for a Singapore company, then you could get withheld against at 17%, but then it's a simple matter of filing effectively a permanent establishment return in Singapore, being taxed on a net basis and getting a foreign tax credit. So that's not very interesting. Interest is probably the more interesting one, because if a Indian company, let's say, provides funding to a Singapore company, okay? Let's say you use debt and we don't use a hybrid instrument, we don't use ordinary shares, then Singapore requires you, and India too, will require you to have interest, right? So when that interest is paid, we levy 15% on tax. I'm not sure what the Singapore-India DTA rate is. It could be 10% based on memory, I'm not sure. So there's an issue of timing, because Singapore basically imposes a date of payment and a withholding tax obligation is different to other countries. So something to consider there. Royalties is basically everything else. So in most cases, royalty here happens to be in terms of the use of an IP. So I had an interesting scenario with an Indian client the other day of royalty withholding tax, because Singapore imposes withholding tax when the amount is due and payable. So, but because of COVID and everything, the client's saying, I'm not paying any interest, any royalties in the situation. But we still have to do the compliance because it's technically due and payable. So we, instead of helping them structure the royalty payments so it doesn't trigger withholding and everything else, but there's just something they wouldn't know. And then there is withholding for rental of movable property in a certain context. So as I mentioned, so the thing to note, similar to India now, I understand you've abolished your dividend distribution tax, so you have no dividend withholding tax too, I think, to non-residents, which is a positive. Obviously, Singapore's DTA has reduced this withholding. The date of payment, as I mentioned, is very weird. It's the earlier of the amount when it's due and payable, when it's credited to the account of a non-resident, and when it's actually paid. So you have this whole issue and confusion on what does credited to the account of a non-resident made. My interpretation is that this usually doesn't apply. So usually if you want to delay withholding, you would delay when it's due and payable in the contract. But the main issue here, which I had with an Indian client recently, is they, for some reason, had delayed their interest payment till the end of the term of the loan. Okay? But this created a mess because in the Indian books, they were recording interest income and being taxed on it. Okay? But then they told me when we finally did the withholding tax after year 5, they then told me they couldn't claim a credit all in the final year. And it was a big mess. It was like, what are we going to do? And I told them, well, how is this managed practically? But they mentioned basically year 1 to year 4, it was being taxed, right? Year 5, you only have the interest income of the 5th year, but you have all the withholding of the 5 years. So that's something also to take note as well of that you always need to match up how the foreign tax credit is going to match up with your withholding to claim double taxation relief. There are penalties up to 20% of the actual withholding tax, 5% for the first month, and then 15% for the next 1% per month for the next 15 months, amounting to 15%. DTAs, yes, go ahead. Sorry.
So before we move to the next segment,
sure.
A few questions, probably we'll take them up.
Sure.
Yeah, so one of the questions, if I understand correctly, is an exemption of the foreign sourced income, where you have mentioned that the condition is income should be taxed overseas.
Yep.
So that's a specific question which says, take an example of dividend income. The overseas company would have paid corporate tax, but there's no any dividend withholding. So in this scenario, whether the dividend income would be covered under exemption in Singapore?
Yes, because for dividends, the sub-tax requirement is both an underlying corporate tax in the entity as well as dividend withholding tax. So using the example I had now, UK doesn't impose dividend withholding tax, but if the UK company had incurred taxes, then it would apply, yes.
Okay. The next question is relating shipping income. I've got two questions. I'll club them. One is a very generic question in terms of how it is taxed in Singapore, the shipping income.
Sure.
And piggybacking on that question, the follow-up question is on the, in India, we have presumptive tax on certain presumptive tax basis where you get taxed on your income a certain percentage, especially for non-residents to make their life easy. The question is, how does it deal with shipping company, which has a branch in Singapore? It's a global shipping company, and where freight is billed from Singapore, but the sum is deposited in the UK holding company.
Okay, so let's take the question one by one and go through the scenario again, okay? So first case, Singapore has, okay, so as you know, the shipping industry is a very transient one to the extent that you can manage a shipping business from anywhere to a certain extent, right? Because your ships could be anywhere. So Singapore wants to be a hub for shipping, and it is a hub for shipping, right? So you have two exemptions, 113A on the Income Tax Act, 113F, okay? So 13A is a standard exemption that says, look, if you earn shipping income from a ship and it has a Singapore flag, you're exempt. So in many cases, businesses will put Singapore flags, will buy ships, put Singapore flags on them for this specific exemption, okay? Now, the more, more questions is good. The more interesting one comes to, so my understanding is, if you want to ship within India, you have to have an Indian flag. So I think that's correct, right? My understanding. So therefore, the 13A option doesn't apply. So what many clients too on this who have managing shipping come in Singapore go under what is known as the AIS scheme. Okay, this scheme is a scheme Singapore says, okay, if you bring a number of ships, number of people, personnel, business spending, et cetera, into Singapore, we will exempt your shipping income even if it's non-Singapore flagships under 13F, right? So, but this is entities of size, so it's not just one fellow, one ship, one employee sort of situation. This is more substantial business. But I've seen many clients effectively set up their shipping operations outside of India into Singapore in this specific context, right? And their ships are owned by Singapore companies, etc. can we go over the question of the scenario of the freight income and the branch
Yes.
again?
So the situation as prescribed is how does a global shipping company deal where it has a branch in Singapore and the freight is billed from Singapore, but whereas the sum is deposited in its UK holding account. So how does this get taxed?
No, okay. First of all, remember, if we go back to a fact again, right? So Singapore sourced income is taxable irrespective of where the funds are placed. First point, right? So if you have a Singapore company with, let's use the example of my company. Let's assume I'm giving you advice from Singapore. Even if I have a bank account in Timbuktu, right, the income's still taxed, right? So in the case of Singapore takes the interesting view of shipping income or freight income. They view that the source is where the decisions are made to manage the shipping business. It's not where the ship is. So some countries take source and say, oh, if you're managing a ship and it doesn't go in wide waters, it's foreign source. Singapore takes the view that income is Singapore source to the extent it's managed in Singapore. So in your case, and me having freight income and it being booked in the UK, that's not relevant to that extent. The only way that I would have a discussion if that was happening is I would say, are we sure there's not some transfer pricing involved here? Because why would the income get booked there? Should there be some margin that the UK takes or not? I don't know, right? But that's my answer to that question.
All right. So I'm taking up all the questions so that I don't miss out, deprive the attendees of any questions, not filtering them. One other question that has cropped up is if the Singapore holding company receives dividend from overseas subsidiary and then pays dividend foreign parent, is there any tax on dividend received from subsidiary? Two, is there any withholding tax on payment of dividend to overseas parent company? Even though you've addressed it, maybe if you can retouch it.
Okay. So let's take this in its form. Remember we were discussing about, so we always have three sections, right? We have source, Singapore in the middle, and then parent, right? In however any income that flows, right? So the first question is, are we going to remit the dividend income into Singapore or not, right? So as I mentioned, some treaties require remittance in order to get lower withholding, right? So if we remit it in, assuming the foreign source income exemption applies, no tax, and the income's in, and then no dividend withholding tax, okay? Let's assume we don't need to remit it in for some reason. We can just pay it directly from the subsidiary to the parent, from the subsidiary of the Singapore company to the parent. And then then there's not tax in Singapore because it hasn't been remitted. And then there's no dividend withholding tax. So you can pretty much get a tax-free scenario in either case. So the question of remittance is usually just one of, the question I always ask clients is, do you need to remit, right? Not should you remit on it, do you need to? If you don't, why bother? Because then this is not even within the tax net. Okay.
All right, Sanjay.
Any more questions? Or I should
quite
continue?
a few.
Okay, let's go. Come on. Sure.
Yeah. So these are Singapore specific, not treaty. So that's why I'm taking them now. So anyway,
Sure.
next one is on the treaty aspect.
Sure.
How is the profit share earned from an Indian LLP taxed in Singapore?
That is a very interesting question. Okay. So the first question is this Singapore source or foreign source income, right? So my understanding is in India, please correct me wrong. This is, if you can start to ask this, or maybe the audience can. So my understanding is the LLP files its own return, right? But then it's for the partners. Is that correct? Or does each partner file their own return?
LLP files its return as well as the partners, but the profit gets exempted in the hands of the partner.
Right. So the partners per se don't pay tax, right?
On
correct?
The profits, yes.
They don't pay, right? So it's weirdly, your LLP is a weird, like hybrid sort of instrument because it's, in my LLP in the Singapore context, the LLP does not pay tax. The LLP files a return, but doesn't pay any tax, and then the partners file returns based on that. So you create a weird scenario because it's clearly foreign sourced income because there's nothing to do in Singapore. The partner's not doing anything. There's an LLP that's doing something down there, right? So if you remit it, it's not dividend income, so it's not exempt, right? Okay. Then you have the interesting question, and this I find very interesting, which is if you are silly enough to remit this income, can you claim a foreign tax credit? Because technically you're saying the partners haven't been taxed, right? So what credit would he take? He hasn't paid any tax. So then you think, no, but underlying tax has been paid. So this is when you get into MOF, inland revenue territory. So if I had a client who actually did this, I would write to the Ministry of Finance and say, hey, this is my scenario. And I believe the same scenario applies. They tell me, okay, cool, we understand. Tell us what you're going to use the money for, you know? And then I think they'd consider it and probably grant it in the end. Because from an objective perspective, but even if they didn't grant the exemption, I would say, please give me a credit, right? Because ultimately I have paid tax, right, through my LLP, right? It's pretty unfair. Well, unfair is probably not the right word, but you know, from my perspective, I think they should personally. But as you said, law is not about how I feel, but it's how I feel.
So just a follow up to it. So you're saying at the first instance, the first entry, so that the Singapore tax authorities are okay to even access the India-Singapore treaty in this context, despite the taxpayers being two different persons?
No, but this is not a treaty context. That's my point. It's nothing to do with treaty because the question is, do you even, from a technical perspective, there's no double taxation because the LLP is taxed and the taxpayer is the partner, right? And India is not levying any tax on him, right? So there's no double tax scenario to be discussing. Because remember, treaties restrict source state taxation and require the resident state to provide double taxation relief, right? That's essentially the principle. So the question here is Singapore required, and this is what I say is a brilliant question. Should Singapore be obligated? Because it's not Article 10 dividend, is it? Right? So it's not business profits. Is it other income? I don't know. I don't know. That's why I said it's a brilliant question. You know? But I think, from my personal view, I think in the end, we won't have to pay tax on it, even if you remit it in, because I don't see Singapore double taxing you. Maybe they will, okay? They technically don't have to give you credit, but I see them do. I don't know. We'll see. I don't know. Maybe you should get one of your clients to just for fun, just remit in $100, and then I'll for fun take on the case and see what happens.
Sure.
Cool. No problem. Go ahead.
One question, obviously, this is based on what's happening in India, where we are coming out with cross-border mergers and listing and all those things happening, and India has been opening up. So one of the questions pertaining to it is the inbound merger into Singapore possible? If yes, what are the broad conditions and timelines, Sanjay?
Well, no, okay, let's make it clear. Okay, I received this question probably once every 2 weeks from an Indian advisor. Singapore does not allow cross-border mergers, right? I think Mauritius does, which is maybe where the theory has come from. So a Singapore company can't merge with an Indian one or a Mauritius one or anything else. So the only way to do a theoretical merger is to turn the other company into a Singapore company, right? So you would use that inward redomiciliation that I talked about, right? So theoretically, let's assume, use Mauritius as an example. Let's assume, because I think Mauritius has recently had some issues with the FATF and the EU and all this stuff, right? So let's assume someone wants to turn a Mauritius company into a Singapore one, or merge a Mauritius company with a Singapore one. It would need to first take the company from Mauritius and make it a Singapore one, and then merge it.
Okay. Sanjay, shall we take one more question? Interesting one.
Sure.
Okay. Hybrid related.
No, to be honest with you, Sudarshan, ask as many questions you want, because I think it's far more fun answering questions. I can obviously go through this too. I'll leave it to you as as the facilitator.
Quite a lot of questions I'm just trying to figure out.
No problem.
How would you treat income from hybrid instrument? Say there is a debenture with equity features. Okay, this instrument would not have any assured return. The upside downside returns would be linked to underlying payoffs of the investee. So in summary, it has substantial equity, quasi-equity features. So would the redemption be treated as capital gains or dividends?
Okay. So this is one of my favorite topics in Singapore tax law. So as your audience must know, or they can Google now as I talk, Singapore has a hybrid instrument e-tax guide. As I told you, remember the funny tax guide. The e-tax guide goes through criteria, right? So effectively it says, so to the extent that let's assume the scenario is an Indian company is investing, we can do it either way, but let's assume an Indian company is investing into a Singapore company. So the question is always, is it dividend, which doesn't have withholding, or is it interest, which does have withholding, right? So in our scenario, was it a Singapore company investing into another entity, or was it someone investing into a Singaporean? What was our scenario, Sudarshan?
My apologies, Sanjay. I'm just filtering the questions. I missed.
No problem. I will tell you. I'll give both scenarios. So assuming we have the case of an Indian company investing into a Singapore one, you continue to filter, so I'll continue talking. Then the question comes, so the usual hybrid instrument is usually sort of a redeemable preference share. That's usually what the hybrid instrument is in the context of a Singapore thing. So the question is always, does the Singapore company have the obligation to repay anything? Is effectively the usual question, right? Where it has something more to repay, like an obligation to repay principal, an obligation to pay preference dividends, an obligation to do anything, this puts into a more debt-like feature. Also, a very good proxy to this whole context is the accounting treatment. Because the authorities will often look and say, well, look, if the accounting guys are calling this RPS debt, how are you telling me it's equity? So I would say in the same context, I've had a client before. It was a Singapore company with a UK subsidiary, and they had invested in similar types of preference shares. We went through the same analysis, and because in that case, the UK company had an obligation to pay up, even though they called it dividend, because they had the obligation to repay the debt, an obligation to pay preference dividends at a fixed coupon as and when the company had profit, we treated the income as interest income rather than dividends, right? So but here's the point, UK has interest withholding, so anyway, the tax impact wasn't that much. But so I think the basic fact is to think, what would IFRS do? And it's going to be a similar answer on the other side. But this is a very common thing in fund structures. That's where mostly I see these hybrid structures, since usually I work with clients on that. Cool, next question. Any more questions?
It's very interesting because even recently, if you see, there was a Dutch Supreme Court judgment where perpetual debt was considered as an equity. So, with new advent of financial instruments coming in, I'm sure we're going to see quite a lot of issues.
Of course, because the main problem you have in this, it is every feature matters, right? You know what I mean? It's not just, it's easy doing in every scenario, I always say the 0 and the 100, right? It's easy to spot those two, right? And that's what you get in the textbook, right? The 0 and the 100. The question is always, what do we do with the 45? What do we do with the 65, right? What do we do, right? Which way do we go, right? And that's the fun,
But one last question, and then I will leave it to you for the next segment, is how would you treat trading receipts by a non-resident into a bank account in Singapore? Would the non-resident be exposed to any tax risk owing to the mere receipt in a Singapore bank account?
Okay, so there was an e-tax guide released, and that's now been replaced with something on their website. Singapore wants to be used as a banking hub. So to the extent that the non-resident has no operations in in Singapore, then the income in the Singapore bank account won't be taxed. So it's very important that you only have such a structure as in when you have no operations in Singapore. So usually it's a relatively odd scenario Because usually the bank wouldn't open the account with no operations in Singapore, but it obviously could be the case. But let's say the scenario is a Dubai company opens up a Singapore bank account, right, as an example, to do trading. But there'll be no tax in Singapore because there's nothing there.
Okay.
Okay.
Sanjay, sorry, this is something which we had raised to you earlier as well, as part of
Sure.
a initial questionnaire.
Sure.
I'm not sure whether probably you can maybe dwell further on this, because this is a common question which a lot of Indian startups keep posing, for us to flip or do an externalization model is, what are the incentives to house, transfer the global IP to a Singapore? You talked about the benefits Singapore brings. Is there any specific IP specific regime that attracts Singapore, or is it just the other tax and regulatory which attracts?
It's not really, because see, Singapore, okay, let's think from a policy perspective, okay? Why do you attract foreign investment? Even in India, you had this made in India concept by the Prime Minister, remember, that was there. So that's to create jobs, right? So ultimately, there are like allowances for IP, there are certain things, but per se, there's nothing specific for IP that attracts this. Because does it create jobs is really the ultimate question, right? So that's really what it's all about, especially, you must agree, in this post-COVID environment, okay? Where sadly, in my view, may have some unemployment, right, in countries as a result of the change, unfortunately, in lives. And as Sudarshan has said, obviously, I hope you're all staying safe at home. It's a very terrible situation we're in. There isn't, because there is no incentive to do so, right? Now, but the basic law itself is good enough, right? If you transfer IP, you're taxed at a lower tax rate, you have a numerous number of treaties, you can have your substance there, and then there's no capital gains later when you sell this business, right? You can develop the IP there. So, but there are incentives for R&D hubs. So let's say, for example, so I have clients who set up R&D operating in Singapore, but it has to be of a certain scale once again, right? It's all about scale. You don't get a free lunch, right? It's not a free lunch, right? Already the lunch is quite cheap, is how I like to be put, right? So you're not going to get a further discount. Okay, continue.
So one of the reasons for me asking this question is so that it will be a good segue into the next segment, which is obviously the DTW and MLI, which you're going to take. So one question, to start off, so that you can take the thread from there, is obviously, when it comes to MLI, one thing that has been humming everywhere is some even call it the kind of akin to virus, is the PPT, the principal purpose test. So is there any specific guidance given by the IRAS on principal purpose tests? How are the tax advisors or the administration will cope up with it, considering that MLI is effective in Singapore as well?
See, here's the funny thing, okay? So this whole scenario, I've had many of those questions, and this is akin to the same question I used to get. Do you remember in the old days when we had the protocol which provided no capital gains in India, but you had that, was it $200,000 test, and people used to ask me similar questions. Oh, how are the operating expenses done? And ultimately, the problem here is the revenue has released guidance, but very brief, just saying, look, the purpose of the MLI is to make sure that people don't use the treaty for only the purpose of getting benefits. But the problem is the Inland Revenue probably are rarely going to apply it, right? Because it's the source state who are going to apply the MLI, because most likely, because people are not going to, in practice, going to invoke a specific treaty to prevent Singapore tax, because ultimately we have no capital gains. She'll never set up a holding company, right? For that case, we don't have dividend withholding. So really the only scenario would be through interest, but then what structure we create? So I don't, and also you're unlikely to avoid a permanent establishment in Singapore. So I don't expect it to be applied, but once again, there's no split guns, but I expect it to be reasonable. I expect them to take a position. They will probably take a very broad position, similar to what any OECD commentary says, any other cases that may have come out, but they will take a very reasonable view, is my view on this. So they won't be doing it. Here's the thing, the revenue here in Singapore don't act based upon the tax result. They act about getting it right? Getting the right answer. I had one scenario where the revenue told me that one of my clients had done their foreign tax credit calculation wrong. We didn't agree, but then we followed their method of doing it, and my client got a refund of 100,000 Singapore dollars. And the revenue accepted, said, great, they sent me the check the next day, you know? So it's not about the answer in this sense. So coming back to DTAs, okay, so about 90 DTAs. I won't bore you to go through them. Most major countries in the world. I've mentioned the limitation relief clause, so this is, here's the interesting part. So this basically says, look, take an example of dividend or interest. Singapore doesn't tax foreign source dividend and interest, but if you bring that interest into Singapore, then it becomes taxable. So these limitation of relief clauses are saying, hey, we're only going to give you treaty benefits to the extent that you remit this income in. What does that mean? Taxation at 17%, but reduced withholding. So use an example of Indonesia, for example. I think withholding on interest is 20%. I think the treaty brings it down to 10%. So you have that benefit to the extent of you'll be taxed at 17, you'll get the foreign tax credit for 10, but you're taxed overall at 17 instead of the 20 or the 30 in a country. So the most interesting part is this clause is slowly in the newer treaties of Singapore being removed. I'm not sure specifically why, but it's clear this clause should only apply to foreign source income and not to domestic. I think there was a couple of cases in 2015 or something in the Indian context that dealt with this, and I think they came to a conclusion. MLI, PBT we've talked about. As I said, it's obviously, Singapore has subscribed to it. It's going to agree to put it in its treaties. But I think this is not for the application in the Singapore context, but more in the foreign country context. Singapore realizes that, hey, they don't want to be a jurisdiction where people are using treaties for the principal purpose of getting these benefits. So they support this regard. They obviously are going to agree with mutual agreement procedure and arbitration. And I think they will also agree with specific list of activities for having no PE. So they're trying to limit the changes that are happening in these DTAs, but trying to be a good corporate citizen like Singapore always has globally. We had talked about this before. I'm not really sure about slides here, but the data payment, which is caused the main issue, as I had mentioned before, is the early of actual payment payable by contract creditor non-resident. The main issue I foresee, as I mentioned, is timing. Because if the contract says that the interest is due on in the end, if you only make the interest payment at the end of the loan, there's a question of how do you get the foreign tax credit later. And we've discussed penalties, 1%, 5% on our first month, 1%, maximum 20%. Residents, okay. So this is the one, I mentioned a few common questions. This is another one. When people set up holding companies in Singapore, the question is always, hey, we want the company to be resident. And this basically comes down, under domestic law, a Singapore company is a business which basically is managed and controlled in Singapore, okay? So what they look for is the fact that you are managing the company from Singapore. So obviously directors have to be in Singapore, employees have to be there. You can't just use a local nominee director provided by a service provider because they aren't truly exercising management and control. You need to have board meetings in Singapore. You may need to have a majority of your board in Singapore. But the key issue, which clients don't realize, is you'll also have domestic laws in your foreign country, which will almost override these. So in India, you may have POEM rules, right? So notwithstanding that I can be considered a Singapore resident for tax purposes in the Singapore domestic law, if India considers it to be resident because of its laws, let's say your POEM rules or something, then you're going to go to the tiebreaker rule, right? And I believe the tiebreaker rule is effective management. So it comes down to these basic requirements, and they're a bit more complicated than this. They provide almost like a minimum threshold, but in practice, you need to do more, and I've helped clients do much more in this context. Personal tax. So remember we talked about the context of, let's say you want to have substance in Singapore, you want to internationalize, a promoter is sending his family or sending senior personnel. These situations are often quite important in this context, because the question usually is, hey, what's going to be my tax liability over there, you know? I got more questions. I guess, Sudarshan, you'll come in once. Should I talk? I just saw a question on the residents. Should I talk about that, Sudarshan?
Go ahead, Sanjay, if you're able to spot it.
Sure. Okay. So in terms of my experience of obviously obtaining a certificate of residence, the usual process is that you will submit your application. If you're an investment holding company, you will obtain a query from the Inland Revenue asking, for example, who are the directors, who are the employees, have you held board meetings, who owns the company, are you resident elsewhere, what key decisions have you made. So the practical experience has been where you have appropriate substance on the ground, meet these conditions, you often are treated as a Singapore resident. There are specific laws this year in the COVID where they realize, look, you may not be able to hold board meetings, you may not be able to have employees. So they've taken a position that you can use last year's. If you've got it last year, they'll give it to this year as a concession. But it's a relatively simple process to the extent, let me see, oh, the question's gone. It's a relatively simple process to the extent that you can answer these questions and get it, but you need to really have that real substance on the ground, right? So the question always comes is cost benefit. You have to have an office that costs rent. Employees cost salary. Board meetings, administration. You have to make decisions in these board meetings. You have to be organized how you do this. You know, there's a lot to do it. So the assessment is basically, hey, we're getting more questions. This is good. So Darshan, you can just start shooting them as you see them, okay? So the question here is ultimately, it's like a smell test. Do you have this concept in India, smell test, when you look at things?
Oh, yeah.
Yeah, right. Yeah. Right. So this topic, as with all the topics I talked about, usually within the first 5 minutes I talk to a client, I know the answer. This is a smell test to what's going on, right? So ultimately, if some fellow comes to me and says, so example, often we have this discussion. I'm like, oh, okay, cool. You know, so to be resident, you need to have a director and everything else. Oh, I have a guy. I said, oh, cool. I always say, can you send me a CV? Because often what these clients do is they don't understand. It's just they find some random fellow off the street. I'm like, how can he be your director? He's got no CV. So you have to have people, because the revenue will challenge you on these things, right? Hey, who are these directors? Not probably to the level that your poem guys will in India, I would expect, but it comes down to reasonableness, right? Sorry, go ahead, Sebastian. Any questions, or have did I answer, or cover? I should continue.
There are a few questions. I think we have very limited time. Shall we take the questions, Sanjay, or unless you have any specific important aspect to cover, we'll take the questions so that.
No. I mean, I'll just make one point on this. The territorial tax system, 22% marginal rate, so lower. You should expect it to increase. Let me see if there's anything else in here. Anything of relevance? No. Okay, let's go to questions.
Okay. So one of the questions is on, again, dividend. I thought this is something which, we are very keen about in India in advice. Sure. So there's an, trying to take the. So there's an Indian company which has a subsidiary in Singapore, which in turn holds a Dubai entity.
Yes.
Now, if the Dubai entity directly pays its dividend to the Indian entity taking the beneficial ownership concept, so will that have any implications in Singapore? Will the headline tax of 15% be an issue?
No, it's not remitted because the money goes directly up.
So you don't foresee any issue there?
No, because you pay the money directly from the UAE account to the India account, no issues. You just do a paper dividend. That's fine. No tax.
Okay. And then, is there any outbound redomiciliation permitted in Singapore?
No. It's it's like Hotel California. You can arrive, but you can never leave. No. Yeah. Okay.
And how does the group tax system work? Do you have a group tax system in Singapore?
We don't have consolidation, but we have group relief. So if you have certain conditions you apply, you can transfer losses. But it's rarely used because in my client base, especially because I rarely have clients who are in a group and someone's making a loss. Most of my clients make profit or they're just one tiny company don't have it. But yeah, group relief, normal like the UK rules of group relief, that sort of stuff. So normal, you can transfer losses if you have a certain ownership percentage and are owned by a Singapore company.
Okay, so this is another practical question. Would the Inland Revenue approve residence in Singapore where the non-resident is able to demonstrate poem in Singapore? Just extension to it is with now that we have Article 4.3, this is also all the more relevant. So when you have a poem kind of scenario where you need to go to the competent authority to resolve, so obviously the apprehension the taxpayers have is, how will that work? Do you have any guidance?
So okay, to be honest, I have never been involved in an Article 4.3 competent authority situation, right? But based on my understanding of speaking to people who have, see, Singapore wants to be a good corporate citizen, so it will seek to resolve, right, the situation. But it won't accept the scenario that it doesn't agree with. But let's be clear. In my personal view, but I have no facts, okay? If the facts clearly show that the place of effective management is in India, Singapore will agree because, let's be clear, Singapore doesn't lose taxation of any sort if it loses the tiebreaker, because it only taxes on a source basis predominantly, right? So residency is not a concept that honestly really matters to me in a Singapore context. So if Singapore gives the COR and India says, I'm sorry, no, we have POEM, I would expect in the end, if the facts were there, Singapore would side in a situation because it won't lose and it wants to be seen as giving the correct answer, right? That's my personal view.
Do you want to quickly touch upon the VCC structure? But before that, Sanjay, the VCC what we are is one more question, which is something which we had also posed to you earlier is, we talked about PPT and India Singapore also has this LOB clause. So what are your 2 cents, or even more than 2 cents on interplay between PPT and LOB, and how what is the general prevalent view among people in Singapore? Will LOB override PPT, or they both operate together, or how does it work?
I mean, once again, no guidance, so this is purely conjecture in this context. And also, I don't think it would be applied in practice because it wouldn't sort of work. But I would, personal view, say LOB, because it's more specific, right, than the PPT, personally, in that sense, would be. And then if you meet the LOB, then you go to the PPT, is my personal view. But there's no specific guidance in Singapore on that. And I don't think there will, because the problem is we'll never have a scenario where it will be applied because we don't have court cases. We've recently started the publishing of rulings. So but I don't think there'll be a ruling on such a thing like this. Yeah, so that's my view. But unfortunately, as I said, you live in a farm. I believe you have thousands of cases a year on tax, and we have 0. So you have far more fun, and you can say more. So that's my unfortunate limited view on this.
All right. Do you want to quickly touch upon the VCC, Sanjay, the variable capital company?
Sure. No, I'm very, very simply, right, in a few sentences. This is a very positive development for the fund industry in Singapore. Historically, fund vehicles in Singapore have been normal private limited companies. There's been a big issue with solvency and the issuance and the redemption of shares and all this. It's been very pernickety, and the shareholders, for example, of funds have been public. And so the VCC seeks to create a fund vehicle, I believe, similar to those in Europe, which make the lives of fund managers easier and encourages, as you may know, there's a trend now to try and be less offshore and more midshore or onshore, right? So Singapore seems to be, hey, there's no need to set up a Cayman fund, set up a Singapore one, right? It's a sort of angle. So it has various benefits. For example, there's the solvency test is easier. You can redeem shares in and out much easier. There's no public disclosure of shareholders. All the tax incentives still apply. So it's ultimately a much easier regime to follow. There are a few compliance hoops to do, but I see it as a big boon because I can see people setting up fund management entities in Singapore to use this versus if they have a choice between Singapore and Cayman. And Cayman, as you know, is mostly used for US investors. So in the context of whereby you may have the choice, I can see people using it. But I definitely think that if any of your clients are thinking of a fund vehicle and a fund, similar for those same reasons of why Singapore before, I think it equally applies in this context, purely because there's an honest question I have is how long can Cayman last in that sense, in the structures that they have, in everything else, because the world is going in one direction, right? So the question is, when will the world say, hey, I'm sorry, we don't like Cayman funds anymore, right? Then where do they go?
Okay, interesting. Yeah, all the more interesting because this is again, the form of entities are also getting inventive, just like the financial instruments. We have the Luxembourg
Yep.
Foundation, we had the erstwhile, I mean, still have the PCC, and there are some interesting Indian jurisprudence, where they treat uh, the registration of where the funds are incorporated as a tax resident. So that's very interesting under the private law principles, even though the place may be in different place. Anyways, that's another very interesting area. So I
No, of
think
course, no, of course, no. The beauty of all this is that the thing I like about everything more complicated is it becomes more fun ultimately, right? Because if things just stay the same, then we won't have anything to do, right? We probably won't have jobs, so no one will need us anymore. So I'm very pleased that all this is coming into play.
perfect, Sanjay. I think we bang on time. There are quite a few questions. There are a few in the chat, few in the Q&As. I found it difficult to navigate, but
No,
nevertheless,
but no problem. But I'm very happy to, if you want to share them afterwards, to get people to write emails to you. I'm very happy if they want to then you
absolutely.
forward their questions on. I'm very happy to send them emails afterwards, or even have short calls with them, because this is I'll tell you what, speaking to an Indian audience, there's nothing better in the world. Okay, I've spoken globally. To the Indian audiences in terms of quality and the number of questions, I'd say are beaten by nobody.
I can watch that.
Okay, go ahead, please.
So thank you very much, Sanjay. Yes, I would, now that you mentioned, so there are a few questions. So I would request all those, unfortunately, whose questions I'm not able to take it up, please shoot to Sanjay and he'll be happy to answer them. So with this, I thank Sanjay. Thank you all for attending. Sanjay works for, this is Sanjay's email ID at IQEQ. So definitely there's no doubt that his entire IQ was in display last 90 minutes. And you can see his EQ part when he launches his YouTube channel, which combines his food and tax. So that you'll have again perfect amalgam of IQ and EQ. So with this, Sanjay, I thank you and thank you all for joining. We'll soon catch up virtually or hopefully physically before COVID comes to an end. Thank you very much. Take care. Stay safe. Thank you, Sanjay. See you.
Thank you. Bye bye.